Okay, welcome all. Today is October 24th, 2024, 4:01 p.m. Uh, it's been a fun year so far. We're just ending the third quarter, so we're going to be going over third quarter numbers and jumping into projections for fourth quarter. We have Josh Graff from Clark Capital today, who's waving his hands and being all excited about today's meeting. And Jill Sherman and I are hosting this call. Jill and I are actually attending this meeting from Florida, and all is good. Was just up in New Jersey this past week, and everything went well there as well. And Josh, are you in Philadelphia?
Yes, I am in the Philadelphia area.
Great. So what we're going to do today, as all of you know, we're going to go over we're going to turn it over to Josh and Clark. We'll be looking for questions from the audience of anything that's going on in your minds. We have some questions that were already emailed up to us from some clients as well. Josh is going to speak for about 15-20 minutes on the state of the economy, state of the portfolio. Obviously, some things that have been that will be on people's minds. We've been talking about it all year, that the markets don't care if it's red or blue, but they care about green. But we'll talk about that today. We'll also talk about how the market's affected in geopolitical arenas that's going on around the world, with hurricanes, et cetera, and then really projections for rolling into 2025, what's the markets are talking about, especially with the Federal Reserve making interest rates changes. So with that said, please, in the chat below, put in your questions, and we will answer questions as they come through or at the end. And at the end, if there's any other questions, please put them in the chat or email us, and we'll make sure Josh answers them as well. With that said, Josh, take it away.
Thank you, Adam. Happy to be coming to you live from the city of brotherly love. Great weather today here too. But without delay, happy to share my screen and get started. And talk a little bit about the wonderful year we really have been having overall broadly in the markets, right? Particularly on the equity side of things. So I'll start with a review of our economic gauges. Happy to talk a little bit about all the different areas of the economy that you could see here on your screen. Of course, the economy itself, as well as interest rates, monetary policy, what the Fed is doing, earnings and valuations, as well as what investors are doing or thinking. Of course, as Adam said, please feel free to drop your questions, and I'll be happy to stop and pause probably a little bit later on and talk a little bit about the things the topics that are on your mind. So with that being said, as you could see here in our economic overview and our economic gauges, as a reminder, and some of you I'm sure may have seen this before, but our founder and chairman is a sailor. So as we do our outlook, we are doing things in terms of boating. Any place where you see a gauge to the right of neutral, that's going to be more of a tailwind or a positive for the future return of markets. Any place where you see the gauge to the left of neutral, that would be more of a headwind or a negative. And then any arrows you see are just changes that we've made from our previous outlook. So, with that being said, you could see here we have two gauges in the positive position, two gauges in neutral, and one in the slight negative position. So, overall, a pretty optimistic outlook. From us, right? Markets have done really well, right? And we had about 5% correction during the month of April. We had another 8.5% decline from July 16th to August 5th. But otherwise, it has been, again, a pretty positive and benign market overall, a positive one. Many equity indices at or around 20% so far this year. And of course, as you can see with the green arrows there on the bond side, the Federal Reserve, congratulations to you all. We've all survived the interest rate hiking cycle. It has been over a year since they last chose to raise interest rates. They announced in September a decrease in interest rates. So, the adjustment there in the deposit position, of course, lower borrowing costs can be a positive for consumers, for companies. Lower interest rates tend to be more positive for bonds as well. So we'll talk a little bit about that. Of course, overall, right, the fundamental picture appears to be pretty solid, particularly with the economy, valuations, and of course, we'll talk about the slight negative position there with investor sentiment. So just to talk about the economy. So now we're in the neutral position overall here. And ultimately, Clark Capital sees a lot of positives, and but also somewhat of a mixed picture as well. But ultimately, economic growth has remained pretty resilient. So, in the upper right hand part of the screen here, you could see a chart of GDP, or, ultimately the report card for how our economy is doing and behaving. And, ultimately, I like to circle 2% on this chart, as that was the trend for growth prior to the COVID pandemic. So, when I analyze or look at growth, from the GDP perspective, other than the first quarter of this year, all of these blue bars are at or above the 2% level, right? So economic growth has been quite strong, particularly in the third quarter of 2023. We did have a 3% growth rate here in the second quarter. And yeah, in the third quarter of this year, of course, still an estimate. We're still getting data from quarter end of 9/30. But in the third quarter here, our friends down in Atlanta who project what GDP might be, their projections actually been revised a little bit higher, 3.4% projected growth in the third quarter. So, economic growth remains strong. One of the things that we often talk about, is that as long as the consumer remains broadly employed, we like to spend, right? About 70% of our economic productivity is a consumer spending. And on employment trends as a whole, while as you can see in the bottom right chart, the blue line here showing the unemployment rate up a slight tick from earlier in the year, it's still about 4.1%, which a 4% unemployment rate is still extremely low. Historically. So, the consumer remains broadly employed. And, overall, the situation in the job market, as you could see, was one of quite abnormality coming out of the COVID-19 pandemic. Job openings, as you can see, the trend there continued to normalize in the right direction. We just haven't seen the uptick in layoffs that you might see during a typical economic decline or slowing growth period. So, overall, all right, this is an economy that, while we would expect it to slow naturally toward that 2% target, an economy that is likely to cool given interest rates at 5%. Recession is not in our base case forecast at this point, so while I can't rule it out, we do think that the economic growth will continue in the positive direction at this point in time. Moving forward into the monetary policy gauge, again, with monetary policy, we are talking about the Fed and their overall decision making and the level of where policy is at. Of course, adjusting this into the half forward position. And you could see in the chart on the right the series of interest rate hikes that we have seen, of course, going back to the beginning of 2022. Again, we went through a period of stable policy. And then in September, the Fed chose to lower the Fed funds rate by 50 basis points for the first time since March of 2020. So we are starting an interest rate decreasing cycle. Of course, as far as impacts go, right, it's always important to remember that when interest rates are going down, bond prices tend to rise, right? So, overall, right, it should be a pretty directly positive event for bonds, as they tend to, of course, to rise and have sort of anticipated, these interest rate changes from the Federal Reserve in advance. Bonds certainly did quite well in the third quarter, particularly on the taxable side of bonds. And as you could see here in the chart from the yellow bars, this is where the Fed Fund futures is estimating the Fed funds rate to go here in the months ahead. Now, of course, for those of you who don't know about the futures, right, this is just a place where speculators and gamblers can go to make bets or place bets on where they think that interest rates are going. Right, we're not doing that inside of portfolios, but of course, that is a place where there are folks guessing about what they might do, and so they're pretty smart, right? So they do have an indication of where things might go overall. We are seeing potential for one or two interest rate cuts here by the end of this year. We're still about two-thirds in the camp where there's going to be a cut in November and December, and about 1/3% chance that we may just see one cut among the two meetings that are left here in 2024. But it does appear likely that we will see, or at least it's priced in a few cuts for next year as well, about three or four. So it does appear like, again, the Fed is ready to bring the rate down. Of course, inflation has come down to where they would like it to be, that 2% target. The latest read on the CPI or inflation this past month was around 2.4. Remember, this was closer to 9 in 2022. So certainly moving in the right direction there. And the Fed has come out and shared, in recent months that they would like to get ahead of any potential economic weakness, right, or any cooling in the labor market. In fact, Jerome Powell said himself, right, we do not want any additional cooling in the labor market, right? So point blank, come out and shared, they'd like to get ahead of the cycle, right? And it looks like that they will continue to lower rates or lower policy here in the foreseeable future.
Hey, Joel, Josh,
Yes.
is there anything that would potentially make, so the question that came through is what would make them pause longer, or potentially, I'm going to throw this in there, like what would make them start to raise rates again and basically do a head fake to everyone?
Yeah, no, certainly a great question out there. I think that, as far as the Fed's mandate, right, there's really two things that they're looking at in particular, right? They're looking at inflation, right? They want, stable level of inflation to develop, right? It's not necessarily falling prices, right? Remember that we need as a country to prices to grow gradually. Right. If prices were going down, nobody would necessarily buy anything, knowing that the prices will go down more the next month. So just to make sure, that inflation is growing at around 2% for the target. And then the second part of that mandate is that unemployment rate, right? And folks are broadly employed, that they want stable employment. That tends to, of course, lead to economic growth. Of course, if there were risks, to the upside in these two variables, right? Meaning that, if the Fed was to raise rates or put on pause, it means that the economy or these two variables would be stronger or would reignite a little bit more in the overheating direction, right? If the unemployment rate were to start to fall, right now, right, we're at about 4.1, which has risen from, even lower or historically low levels of 3.4 to start the year. If we were to start to see the unemployment rate trend back towards 3.4 or below 4%, right, that might catch the Fed's eye and say, well, maybe we need to ease up. Maybe the economy is in a lot stronger position than we thought. Of course, the other metric, right, quite sensitive, is the inflation metric, right? Again, as mentioned, that has been trending down quite significantly as well. Again, we were near 9% in the CPI in 2022. Right now, the CPI is around 2.4. The Fed's preferred measure, right? Of course, the CPI is just a basket of goods and services that the government has determined, suitable for what the consumer is paying. Right? The Fed actually prefers what they call the PCE metric, which is the personal consumption expenditures index. And that's around 2.6. So again, both indicators are heading closer to that 2% level. But, if we were to see PCE start to rise back towards that 3% level or higher, we were started to see a reignition of shelter or home costs, a reignition of some of those car prices, which have come down quite a bit, a reignition of food and energy prices, which still are disinflating from where they were in 2022. Any reignition in those components, like we saw a couple of years ago, that would certainly, raise an eyebrow from the Fed. Adam, I believe
Yeah,
you're on
yeah,
mute there.
sorry. Another question that came through. It's like, okay, all I hear is on these channels and everything else is what's the Fed doing? Why the Fed? Why the Fed? I'm here looking at this as my investment portfolio. Why does the Fed drive what's happening in the market?
Yeah, no, great question, right? So, part of what the Fed sets, right? They set a very short-term interest rate. So I'm actually going to skip ahead a few slides and head into the interest rate section because I think, as far as interest rates go, of course, they set a restriction on borrowing costs, right? So ultimately, what that means, and you're looking here at the yield curve. This is the various plotting of interest rates. The government treasuries that are out there. The Fed controls the short-term rate. So think about your checking, your money market, your savings accounts, right? The Fed controls what the rates are really, really short-term, 1 year or less. Right. So as the Fed lowers rates, right, these rates are really going to come down. Unfortunately, the income on some of those short-term vehicles is going to come down as well. So what's going to happen is that investors are going to need to look elsewhere for the replacement, perhaps, of some of that income, particularly longer out. And what happens as well, with interest rates is, of course, mortgage rates are based on the 10-year, right? We have auto loans, there are credit card rates as well, prime rates for lending, right? Ultimately, all of these interest rates filter down into the economy. So, depending on where, interest rates go, right, that can really affect what consumers choose, right? How affordable mortgages are, right? Will builders continue to build homes given the affordability, right? Are folks buying cars? Do we need more production? Is there more demand? Through the economy for auto loans. So, as they lower interest rates, right, that might stimulate the economy in particular, which would ultimately lead to stronger economic growth and stronger earnings and a stronger consumer. Certainly would help stock portfolios. And then ultimately, right, depending on where clients are invested or what they're invested on the bond side, right, whether they're in those savings, checking or money markets, or maybe they're thinking about a little bit longer in terms of fixed income or bonds, that might affect what they might do. Clark certainly is positioned in the intermediate. We're 3 to 7 years long for our intermediate bond strategy. So we kind of are in that sweet spot, right, for bonds, where we get the benefit of the income while also getting some sensitivity to lower interest rates as well, which should help on the bond side.
Got it. Thank you. And since you're starting to talk about bonds, I know Clark's position has been over the last 6 to 12 months that this is a sweet spot, a new change in the bond market where there hasn't been any yield from bonds. So is this a time where there's a lot of active trading in the bond market, and what are you guys doing for our clients?
Yeah, no, there's certainly, of course, volatility across the bond environment, right? We know that there's a lot of things going on out there in the world, let alone, of course, what the Fed is doing, what's happening in the economy, but of course, things that are happening overseas. And of course, we all might have heard that there's an election coming up here in a couple weeks. So, of course, there's a lot going on and a lot for investors to digest. But ultimately, at the end of the day, right, Clark is picking individual bonds, whether those are municipal bonds, right, that are tax exempt at the federal, and for those, in their state, right, state tax exempt as well. But also, we have a taxable strategy, and we can invest in intermediate corporates as well. Right now, again, typically maintaining that 3 to 7 years in length. As you mentioned, Adam, right, we have interest rates that are as high as they've been in over 10 years, right? So the ability to lock that in for, 3 or even 4 years long, that's really where Clark is positioned. Right now, the average length of our taxable strategy is around 3.9 years in length. The tax-free around 3.8 years. And then, of course, the yield right now in the taxable space about 4.8, and for the munis around 3%. Again, for those munis, those are federally tax exempt, right? So, of course, depending on your tax bracket, right, ultimately trying to get the best tax or the best return at the end of the day. And again, I kind of highlighted a little bit earlier, being in that sweet spot, right? So, of course, another topic for another day, but part of the issue on the longer end of things is government spending and treasury issuance, right? That affects what the yields are there. Again, we talked about what the Fed is doing on the front end of the yield curve. Right, being in the middle helps us get some of the income on the front, some of the sensitivity from rates coming down, while avoiding some of the risks that are 10, 20, or 30 years out.
So that's a great question. Just followed up. What's the bond risk with the pace of our national debt being rising? Are there bonds that are at risk, and what bonds would they be?
Yeah, so at Clark Capital, ultimately, we are invested in investment grade quality for our bonds, right? So we're talking about really, really high quality. On the taxable side, we have bonds, that come from JP Morgan or Apple or Wells Fargo, right? Really high quality issuers. On the municipal side, very similar story. So our bonds are AA rated as far as the state and local governments go. Of course, nationally, there are various states that are, very good position from a debt perspective. So the bonds we have, well, I can't make any guarantees, right? We feel pretty strongly and pretty confident the bonds that we have do have the ability to pay back the principal plus the interest on that debt, right? If there is something that's sensitive, right, it would be the government, in particular, the government, federal government treasuries, right, that are a little bit more sensitive to rising interest rates in particular. Something to keep in mind, though, right? I do have some ancillary slides, perhaps that I can share, right, on that, right? There is the debate out there that says that, right, if there is more spending or a higher level of government debt, that may lead to a higher level of interest rates on that debt. So what you're seeing here, this is a chart that kind of gets into that, where the blue line is the federal debt and the total debt to GDP as a percentage of that economic growth that we have. Now, and you could see back in 1970, our debt to GDP ratio was around 40, where it actually went over 100, right, back in 2011, 2012. Our debt to GDP ratio has actually fallen since 2020. Not a story that many are talking about right now. Of course, we'd like to see that trend continue. But the red line is the yield that is on our 10-year treasury. So again, the thought process is that higher debt or more spending leads to higher interest rates. Well, that's not necessarily the case, right? Remember back in the 1980s when interest rates were in double-digit territory, we've had a 40-year, of course, bull market or drop in interest rates since then, even though, of course, spending has been rising. So, of course, we saw, interest rates go up, over the last 3 years. But now with where the Fed stance is, right, we're starting to see them come down a little bit. So, not exactly highly correlated, but of course, we want to make sure that, we can get a really good yield in the middle without taking, some of that extra interest rate risk that might become from government securities.
Great. Thank you for that answer. We have nothing else in the queue, so you can keep going with the portfolio or the presentation.
Sounds good. So next up, we can talk about valuations and earnings, particularly within the equity markets. Remember, when we talk about valuations or earnings, right? Ultimately, kind of gets into the reason why we invest in businesses out there, right? Ultimately, we want to make sure that the businesses are growing, right? They're earning, they're more profitable, right? So that we can sell them for a higher price. in the future. And so when we talk about, to start with valuations, right, there are many fundamental or historical valuation metrics that we can look at to analyze how expensive or cheap a market is. Of course, our gauge is in neutral, right? Overall, we do think the valuations are around fair or a fair value. So this chart showing you the S&P 500 with the red line there here in the middle, and we're up to just around 5,800 on the S&P, of course, achieving record highs here in recent weeks and months, particularly in the third quarter. The blue line is the PE ratio, right? So the price to earnings ratio, basically how much are we paying for each $1 that these companies are producing. When this line gets really high, I would say a market is particularly expensive, right? We saw peaks, particularly when things went up towards 30, right? And then also valuations can get cheap, right? And there are particular time periods when, that blue line did make lows here recently. So, of course, as you might guess, right, as the prices on the S&P have risen, so too have valuations. Now, again, if I drew a couple lines, within rhyme or reason around where we've been over the last 5 or 10 years, I certainly think that we're within that two lines there, right? We're within rhyme or reason of levels. Of course, I think we're probably towards the upper end of that range. Important to remember that we do have a significant skew, right? So of the 500 companies in the S&P, right, the top 8 make up almost 35 to 40% of this index, right? And these top 8 are about 29 times earnings for the next year. Right, there are 492 other companies that make up the other 65% or so of this index. Right. And those are much more fairly valued, somewhere around 18, somewhere around 19 times next year's earnings. Right. So, if you were the professor of a classroom and you had 30 students, right, and maybe in the beginning of the year, you had 7 students who never came to class and got straight A's. And then, of course, you had the other 23 students or so that, while they did come to class, they weren't doing so well. Now, when you analyze that classroom from a high level, right, it's doing okay. But of course, the teacher knows, the professor knows, underneath the surface, right, those folks need help. And so ultimately what happens, of course, is that the folks that are coming to class, that ends up helping and those that don't come to class, right, that ends up catching up at some point, right? And so, we actually saw in the third quarter the market start to broaden out to some other sectors, right? Obviously, there is a heavy technology bias in those top 8. We've seen utilities do pretty well, financials, and some of the other cyclical sectors, particularly in the third quarter, do quite well. In fact, the equal weighted, right, if you had an equal weight for all of the 500 companies, was actually up about 11% in the third quarter, as opposed to the top 8, which were only up 5%. In the third quarter. So we're starting to see, the economic performance really start to broaden out, right? There are other valuation opportunities elsewhere in the market, and we're starting to see both from performance and earnings performance really start to broaden out into some of those other areas, other sectors of the market that do have better valuations elsewhere. Also, in addition, on the earnings front, as you could see here, we continue to see earnings growth, right? Remember, right, as earnings grow, so do the prices within the S&P 500. We did achieve a record high in 2013 for earnings. Right now, we are seeing a pretty solid, a near double-digit growth rate for earnings as we head through the third quarter. Right now. And you could see out in 2025, Wall Street forecasts have gotten pretty rosy. We've seen earnings expectations for next year rise from 13% to 16% during the quarter. So earnings growth continues to go up, right? Certainly that's positive for the market overall. Right? I think there's one thing we can all agree, is that sometimes they get a bit excessively optimistic on Wall Street from time to time. I think as we go through 2025, we'll likely see this number come down a little bit, but ultimately, again, I drew a red line. There is a lot of room for growth here. Again, earnings, corporate profits have been resilient, continue to grow, and that should lead to a positive environment for equities. Ultimately, and the one gauge that we have here in the negative position is the investor sentiment gauge right now in the slow or slight negative reverse position here. With investor sentiment, this is based on investor emotions. So of course, our emotions change with the wind; they change all the time. Keep that in mind. This is also a contrarian indicator. That might be confusing for any fans of Seinfeld that are out there. This can also be referred to as the Costanza gauge. Remember from one episode of Seinfeld, George Costanza, he decided he was going to wake up one morning and do the opposite of what he said he was going to do, and that ultimately made him happier. So in this case, perhaps when we're seeing George and his friends jump up and down about the stock market, jump up and down about the economy, be really excited about where things are going. Maybe we're even hearing about Bitcoin or cryptocurrency in the news or the media, right? We might be a little bit more cautious, of course, in the short term about the greed there. But of course, if George and his friends are scared, they want nothing to do with the economy or stocks and are running for the hills, right? That's where Clark Capital would be excited and would jump in with both feet. So, generally, we do gauge George and his friends' thoughts and feelings that are out there through a survey. The American Association of Individual Investors, a survey that's been around since 1987. But with what we're seeing, you can see the historical averages within the survey, right? In the green, those people are excited about the stock market. In the red, those folks are scared, right? Generally, what makes a market, right? There's a nice even view historically, and generally we've been right around the historical average. All right, so now ultimately the gauge is in the slight position, right? We're not seeing anything extreme at this point in time, but certainly given the stock market rally over the last 2 years, right? George's friends have been getting excited. We have seen a lot more green here in the survey, right? So again, we have some things to work through, right? There's been some geopolitical headlines, of course. We have an election. Ultimately, there does tend to be some fear that rises as we head towards the election. So, of course, we do think that given the optimism out there, that there is a slight caution here. Between now and the next few months, but ultimately, again, the fundamentals remain strong, and ultimately the fundamentals prevail in the medium and long term.
That's great. Thank you.
Absolutely. We did cover interest rates a little bit, again, in the slight positive position. Generally, we have seen interest rates come down. And in addition, we have also seen, the yield curve, particularly the blue line here, which is on October 1st, actually uninvert during the quarter, meaning that you actually do get paid now a little bit more to invest on the longer end than you do perhaps in the 2 or 5 year category. The 10-year finally going a little bit higher than there. And generally, that is normal, right? We have had an inverted yield curve in particular, right, which that can be a warning sign of slower economic growth ahead. But again, good to see the yield curve get back. And of course, as the Fed brings rates down, right, things continue to normalize here. That just about does it for the gauges. Are there any questions that I can answer in particular at this time?
We don't have anything in the queue for gauge questions. I think you did a great job going over the overall economic gauges that Clark looks at from a macro picture. So you can move into your other topics.
Yeah, I think that certainly, given that we see the election coming up here in a few weeks, we could certainly talk a little bit about what's happening here. And I think, I think it's obviously a very important question, and one that should be answered and addressed here. This chart here, this one is one of my favorites, and again, kind of highlighting what you started with, and to open our presentation, right? So this chart here is a chart of the S&P 500. Going back to January 1st, 1933, conveniently color coded in, of course, for who was running the White House during that particular time period. Back in 1933, the S&P was at a level of 7. Today, as I mentioned, we are around 5,800. So, I think we can all agree, right? Our country has seen a lot of growth going back then. And look, no debate from me. We've certainly had bumps and bruises along the way. But ultimately, it doesn't really matter whether things are red or blue, right? And Adam, you kind of highlighted this, and what Clark likes to say is the market cares about the green, right? It cares about economic growth, it cares about economic performance. We think that the stocks and the bonds and the companies in the portfolio can produce, regardless of who's running things out there. I think that we'll probably see some things in the news or the media that we don't like over the next couple of weeks and months. If you're a sports fan, the Giants, the Jets, the Eagles are back on. If you're not a sports fan, I hear that the Dancing with the Stars is back. So I emphasize perhaps changing the channel, going for a walk, taking a deep breath. Do what you have to do, because ultimately we think that things will continue to proceed once the election comes and goes. My next slide that I'll share, I think also highlights and talks about that it doesn't pay to speculate about what's happening in Washington, D.C. In particular. This chart here shows you what you would have happened had you invested $10,000 into the market starting in January of 1950 and held that over a 74-year period to September 30th of this year, the end of the third quarter. And look, what's great about our country is that you have the freedom of choice, right? So if you invested $10,000, you said, Josh, I hate Democrats. I only want to invest when Republicans are president. Your 10,000 would have grown to about 78,000 during that 74-year period. Of course, you can also change your mind, right? So if you said, Josh, I hate Republicans. I only want to invest when Democrats are president. Your 10,000 would have grown to about 445,000 over that 74-year period. But the main theme here is that I could have picked any date. I could have picked 1970. I could have picked 1990, 2001. The main message here is that if you put a blindfold on and you didn't pay attention to what was happening on Washington, D.C. at all, and you invested $10,000 into the S&P 500, it would have grown to about $3.5 million over that 74-year period. Now, again, ultimately highlighting that to stay invested, right? And the folks on TV don't have your best interest in mind, right? Jill, Adam, you guys do, right? I do as well, right? So, ultimately, we think that things will proceed, and we'll be able to move forward once we get through things here in November.
There's a quote that I have in front of me, so I'm going to read it for everyone. And I said it to one client today. It's just in my journal. It says, "Worrying doesn't empty tomorrow of it. Worrying doesn't empty tomorrow of its sorrow. It empties today of its strength." So the point being here is we've been consistent all year long with all of our clients about worrying about the election is just going to hurt yourself. And going to Josh's point, we're convinced that just watch any news channel, doesn't matter, pick one. They're being driven by their advertisers, and that's what they're selling. They're trying to keep eyes glued and to their channel and scare those people so that they can stay tuned in. We want to take your worries away, and I think that this chart and the message that we've been saying to our clients all year round, from your investment portfolio, that's not the thing to worry about right now.
Yeah, absolutely. There, and certainly would agree, right? Benefiting yourself, staying invested, listening to the good folks right here, certainly should pay dividends down the road. Now, I think one of the other topics that I'm happy to cover. I think that would be particularly top of mind, especially with what's happening overseas. So, I'll touch a little bit about geopolitics as well for a few minutes here. I certainly want to start off by saying that, humanitarian wise, it is certainly sad to see all of the lives being lost overseas. I don't think anyone wants lives being lost in particular, and hoping that countries and folks out there can find safe haven or peaceful resolution here in the end. That being said, from a financial perspective, I think one of the helpful things is to analyze how these events impact the companies in your portfolio, the earnings, right? Remember, as it ultimately comes down to the earnings and how those events playing out would affect them. I think that one of the charts that's really helpful. It's on the screen. This was produced at the end of last year, but I think that the message is the same. And that is, you could see in this bubble chart what is or what countries are producing the most out there in the world. Of course, your portfolio ultimately reflects the earnings that are out there. Of course, the United States, number one last year, producing upwards of $27 trillion. China, number two there, FO has risen, to about 19.4 trillion last year. You can see Japan right there, pretty solid. Of course, developed European countries up here in the upper left. But ultimately, if I asked one of you to throw a dart and the odds of that landing on where Ukraine or Gaza or Israel might be on this chart, you'd have a really low probability of hitting it. And ultimately, because they just don't produce or not as significant to the global growth picture. Of course, as we are hearing in the headlines. Again, a lot of the earnings that you have come from, of course, they're going to come from the U.S. And we do have an international strategy at Clark as well. Again, we are talking about mostly developed countries and, of course, businesses that are producing a lot of revenue here in the U.S. that just happen to be headquartered overseas. So, ultimately, the message here, regardless of what bombs may be going off in Russia or Ukraine or in Israel or Gaza in the Middle East, right, that's not necessarily going to stop Adam from getting a cheeseburger tomorrow or your kids from getting Halloween candy at the end of this month, right? So, remember, ultimately, consumers aren't necessarily going to change their choices about the different headlines that they may or may not be hearing. And of course, how this might affect, your portfolio in particular. We've seen a number of these crisis events over the years. We have gone all the way back and analyzed what has happened in stocks, going back to even World War One, of course, through the 70s and 80s, what's happened in the Middle East as well. Also, of course, all the moves that Russia has been up to lately. But as you could see, and you might guess, right, folks in the investment markets, they react in fear, right? This is tracking the Dow Jones as we have the history going back to 1914 to track how investors reacted to many of these events. But the important message, again, once these conflicts were resolved or the direct consequences on developed world earnings was understood or solved, right, the market tended to bounce back, right? And you can see on average over 1, 3, 6, and 12 months, the market reacted strongly in the comeback once these conflicts were resolved. Particularly, we all know the COVID-19 crash, right? Of course, March was not a particularly good month that year, but then the rapid snapback in markets highlights the impact that the recovery can have on portfolios.
We had a question that just came in that's kind of going back to the other slides, but we can kind of stay here. Do you see does Clark see a sector rotation in 2025? And if so, where do you see it turning towards?
Yeah, no. So in equity markets, right, we've seen a pretty strong trend emerging out of the pandemic, particularly in growth and in technology, which has been, the broad leadership for quite a while. And we have been sharing with folks that we continue to think that those are really high quality, but they are expensive, right? And ultimately, we continue to think that the market will rotate into some other sectors. What has really worked here of late, healthcare has been particularly strong, financials and the banks, again, given economic resilience, the banks have been holding up quite well. And in particular, we've seen strong figures from JP Morgan and some of the bigger banks that have a pretty good grasp of economic growth and different sectors there within the company, but and the sector. So, ultimately, as we head into next year, we continue to emphasize, the broadening out, right? And some of those, more cyclical sectors, again, the financials, the industrials participating in some of those AI related themes should continue to do well, right? There are a lot of really strong businesses helping with some of the data center themes that we've seen out there. So in particular, financials, industrials, healthcare, and utilities, right? We need the energy to be able to put these data centers together, the infrastructure, and a lot of our utilities are really important in that regard. So, those are some areas of the market we continue to highlight, right? They do tend to be relatively cheaper than, of course, the technology areas that have led perhaps in prior years.
Great. Thank you. Do you have any kind of closing comments that you'd like to make that we have to hit for either compliance reasons and or just because of it's like a nice ending spot?
Yeah, no, I mean, just to wrap up here, you could see, our closing gauges, right, overall. Again, we do expect the economy to slow, but ultimately to avoid recession, we do think we'll be able to engineer a soft landing. And again, given the strong fundamentals out there, we do anticipate the market continue to head higher as we head into next year. Ultimately, I will show the disclosures here on the final slide to make the compliance department particularly happy there. But with that, that does wrap up, most of the commentary that I have for today. Happy to answer any final questions before parting.
We'll give it a minute, but Josh, thank you for taking your time and walking through this presentation and for everyone that is on the call today, and this will be recorded. I know it's October 24th, so happy Halloween. I'm not sure, Josh, if you want to share with everyone what your Halloween costume is this year, and Jill, I'm very curious of what you're dressing up as this year. I am going to be going to Halloween. I'm going to be a grandfather, so I'm already a grandfather, so I'm just going to be handing out probably like pennies. I'm gonna hand out pennies for Halloween because I know that's what grandparents do. How about you guys?
Yeah, for me, I just love handing out. I love seeing the little kids all dressed up in whatever costume we have. Our decoration is Yoda, so all our kids love us with our little pumpkin. So we're the hit of our street. So we won't be giving out the giant candy bars, but we'll be the spot to stop by. So I'm looking forward to seeing all the kids.
Fair enough. How about you, Josh? Any Halloween tidbits you want to share to end this call?
Yeah, Halloween could be spooky out there, but ultimately the Halloween is on a Thursday, so I probably will stick with the suit and tie over here in my box. I do have an exciting neighborhood, so I'm really excited to see all the kids come around. I love seeing the Superman, the Batman costumes come out. Always really exciting to see the superheroes. And I love to give out some of the Reese's and some of the really good candy that people love.
Okay, I thought that you were gonna go out as Powell, right? Chairman Powell, and you were gonna walk around, but people wouldn't know who you were, so no problem.
Well, I
Well,
have the glasses. I'll just need to I just need to get some other stuff for that.
Well, fantastic. Well, we'll end this call. We will send this call to compliance and then post on our website. I'm sure that all the Halloween stuff will get cut out because it's compliance. But anyway, other than that, thank you all for joining us today, and we'll have one in January at the end of the fourth quarter. Happy Halloween to everyone, and if we don't speak to you, have a very, very happy Thanksgiving. All the best. Take care, and thank you for joining us today.
Thank you all. Take care.
Thank you.